Each method has its own rules depending on your pension scheme and your employer arrangements, taking the total contribution to £3,600. If you want to retire before you're 55, it's not just about putting money aside either, folks. It's about making every single penny count. Right, folks, if I was standing on a street corner handing out £20 notes with absolutely no strings attached, would you just walk on by? Now, whilst I'm not going to do that, I wonder if you're unknowingly leaving free money on your particular street corner. Pension tax relief might sound complicated, but it's essentially the government standing on the corner giving out pension boosts. Now, many people don't realise they could be missing out on thousands by not using it correctly or effectively. Understanding pension tax relief can improve how your current contributions are treated, which in many cases increases the money going into your pension without increasing your take-home contributions and at minimum, possibly even zero risk. And over time, of course, this can materially improve your outcomes, though of course the old risk warning applies. Pension values can fall as well as rise. There's a catch though. Some high earners do face rules that can reduce the tax relief they receive. We'll explain that in a minute, but first let's just cover the basics. Pension tax relief is the government's way of helping you save for your future. The first method is relief at source. You contribute to your pension and your provider claims basic rate tax relief of 20% from HMRC on your behalf. So if you're paying £80, your pension receives an additional £20, making the total contribution £100. Even though I didn't go to university, I'm still canny at maths. Higher rate 40% taxpayers and additional rate 45% taxpayers can claim extra tax relief beyond the basic 20%. For example, if you're a higher rate taxpayer contributing £80 via relief at source, the basic 20% is added automatically by your provider and you can claim the remaining 20% through your self-assessment tax return. Additional rate taxpayers can claim 25% extra relief in the same way. The second method is the net pay arrangement, the NPA, where contributions are taken from your salary before you even pay tax. This reduces your taxable income at source and gives automatic tax relief through your payroll. Now, another option is salary sacrifice. You agree to reduce your salary and your employer contributes the difference directly to your pension. And because your taxable salary is lower, you pay less income tax and you will also save your national insurance contributions on the amount you sacrifice. Alternatively, you can make personal pension contributions directly from your bank account after, of course, you've paid your tax. And your pension provider reclaims basic rate tax relief from HMRC. This is available for both employees and, of course, the self-employed too. Each method has its own rules depending on your pension scheme and your employer arrangements. It's really important to check whether you are claiming all the relief you're entitled to. Now, planning for retirement means maximising the allowances that affect your pension contributions wherever you can. For tax year 25 to 26, the standard annual allowance is £60,000 or 100% of your earnings if lower. If you haven't used your full allowance in the past 3 years, you can carry forward unused amounts allowing contributions above £60,000. You must have been a member of a registered pension scheme during those years and first maximise your allowance for the current tax year. Now, high earners need to watch something called the tapered annual allowance. If your threshold income is over £200,000 and your adjusted income is over £260,000, your maximum allowance reduces by £1 for every £2 above the threshold, down to £10,000 for adjusted incomes over £360,000. Now, if your earnings are under £3,600 and you're under 75 or you have no taxable earnings, you can still contribute £2,880 net of your money and gain £720 of tax relief from HMRC, taking the total contribution to £3,600. Parents or grandparents with surplus income can contribute the same amount into a child or grandchild's pension to generate that £720 tax relief, even if the child pays zero tax. That really is free money. Now, if you've access to defined contribution, which is an investment-based pension above your tax-free cash entitlement, the money purchase annual allowance will probably apply, the MPAA. That actually limits your future contributions to a maximum of £10,000 a year. Now, combining these rules with salary sacrifice, with relief at source or net pay arrangements, that can help you contribute efficiently and maximize your pension returns. Now that you understand how much you can contribute and the limits you need to respect, the next step is thinking about accessing your pension. Knowing your allowances is one thing, but understanding how withdrawals affect tax and retirement income is equally important. Once you've contributed to your pension, you'll eventually need to think about taking the money out and spending it, one would assume. This is where the rules about lump sums and death benefits become more and more important, because the way you withdraw money can affect how much tax you pay and how much is available for your retirement overall. Now, most pensions do allow you to take a portion of your pot tax-free, and we're talking about investment-based pensions here because final salary schemes and defined benefit schemes do have different rules. In 25-26, the standard rule is that you can take up to 25% of your total pension pots as a tax-free lump sum. For example, if your total pension pot is £1,073,100 English pounds, the maximum tax-free amount you could take would be £268,275. Any amount you withdraw above this tax-free sum is taxed at your normal income rate, and that's why we've used those numbers, because that 268,275 number is the maximum amount of tax-free cash any individual in the UK can take. Now, this includes the basic rate 20%, higher rate 40%, or additional rate 45%, depending on your total income that year if you're taking more than that tax-free cash amount. It's also important to note that this tax-free allowance applies cumulatively. That means if you've already taken some tax-free cash, your remaining allowance will be reduced by the amount that you've taken. Taking a large lump sum in a single year can push you into a higher tax band if you take above the tax-free cash amount, which increases the tax on the remainder. For people with particularly large pension pots, generally we say £1 million or more, pensions can affect IHT and beneficiary outcomes, and the rules are really complex and depend on whether benefits have been taken and on the type of pension. For high value pots, it's very, very sensible to get specialist advice, folks, because poor planning, well, this will almost certainly significantly reduce the amount your beneficiaries eventually receive. Right, so now that you know how contributions and withdrawals work, it's important to look at the bigger picture. This includes understanding the state pension, keeping your income under certain thresholds to protect benefits, and using other tax-efficient savings too. Let's talk state pension. The new state pension is £230.25 per week, which is about 12 grand a year. Now, it contributes towards your taxable earnings, but it itself would not normally be taxable because it's under your income tax nil rate band. Now, knowing this helps you estimate how much extra you might need to save to reach your desired retirement income. The personal allowance is £12,570 and the higher rate threshold is £50,270, both currently frozen until 2028. However, it's really important to remember that tax rules will change in the future. In fact, they change all the blinking time, in truth. They're tough to keep up with. Now, this is important because large withdrawals or additional income can accidentally push you into the high rate tax bands, and you need to avoid that because it will reduce your take-home money in reality. Now, for parents, contributing to a pension can actually help keep adjusted net income below the £60,000, which protects child benefit entitlements. Individual savings accounts, ISAs, allow flexible tax-free savings up to £20,000 in 25-26, complementing your pension by giving access to funds without tax penalties. Now, the earliest you can normally access your pension is currently 55, but that rises to 57 from April 2028 depending on how old you are. So obviously knowing your date of birth and scheme rules allows you to plan when you can access your pension and manage cash flow in retirement. If you want to retire before you're 55 or before you're 57, depending on your age, it's important to structure your wealth properly so you've got access to enough money prior to being able to tap into your pensions. Sounds obvious, but Sometimes people miss that. Keeping accurate records is also really essential. Now that you've got a clear picture of how pension tax relief works, how to make the most of your allowances, and how to manage withdrawals, you're in a much stronger position to make your retirement savings work hard. It's not just about putting money aside either, folks. It's about making every single penny count, avoiding unnecessary tax, and planning with confidence. So in the next video, we're going to explore inheritance tax planning and practical ways to legally reduce the risk of losing up to 40% of your estate to tax. Horrible. You'll discover strategies that help ensure your hard-earned money goes to the people you love, or charity. You might love charities, of course, as well. And even small adjustments today can make a significant difference. So click here. See you there.